The phone call came at 3 in the morning. Sarah, a 34-year-old teacher from Bristol, was sobbing into the phone. Her mortgage payment had just jumped from £1,200 to £2,100 per month. After 15 years of teaching, her salary was £42,000 per year. After tax, she takes home about £2,600 per month. Her new mortgage payment alone would eat up 80% of her entire income. She had 3 options: sell her 2-bedroom flat immediately, declare bankruptcy, or somehow find an extra £900 every month for the next 23 years. She chose option 1. But when she called estate agents the next morning, they delivered worse news. Properties like hers in Bristol were taking an average of 68 days to sell, and prices were dropping every week. Her flat, which she bought for £240,000 in 2022, was now worth maybe £190,000. She owed £220,000 on her mortgage. Sarah wasn't just trapped, she was financially destroyed. And she's not alone. Across Britain, hundreds of thousands of homeowners are facing the same nightmare. From Glasgow to Cardiff, from Manchester to Plymouth, a wave of financial destruction is sweeping through communities that thought they were safe. This isn't coming. It's already here. The only question is which cities will be hit first and how bad it's going to get. Let me tell you exactly what's happening right now, because the numbers are more terrifying than anything you'll see in the mainstream media. We're not talking about a gentle market correction or a temporary blip. We're talking about a systematic collapse that will reshape who owns property in Britain and destroy the financial futures of millions of families. The mortgage crisis alone is enough to trigger a cascade that will make 2008 look like a minor inconvenience. Right now, as you're watching this video, 1.4 million British homeowners are sitting on fixed-rate mortgages that are about to expire. These aren't wealthy property investors or second homeowners. These are teachers, nurses, police officers, engineers, and retail workers who bought modest family homes when money was cheap. They locked in rates of 2%, sometimes even lower, thinking they'd found financial security. Their monthly payments were manageable, their family budgets worked, and home ownership felt like the smart choice their parents promised it would be. But here's what none of them anticipated. When those deals expire over the next 2 years, they'll be forced onto new rates of 5%, 6%, or even higher. For a typical family with a £250,000 mortgage, that means their monthly payment will jump from approximately £1,100 to over £1,700. That's an extra £600 per month, every month, for years. For families already stretched by energy bills, food inflation, and council tax increases, that extra £600 doesn't exist. It can't be found in any budget, no matter how carefully planned. These families have 3 choices: somehow find the extra money, sell their homes, or lose them to the bank. The math is simple and brutal. Average UK household income after tax is around £2,800 per month. The median mortgage payment for these families will jump to over £1,700 per month. That's more than 60% of their entire take-home pay, well above the danger zone that financial experts consider sustainable. Multiply that by 1.4 million households, and you're looking at the largest forced property sell-off in British history. But the mortgage crisis is only the beginning. What makes this situation truly catastrophic is how it intersects with everything else that's breaking in the British economy right now. Unemployment is starting to creep up in ways that official statistics can't hide. Major retailers are closing stores across the country, laying off workers in their thousands. The manufacturing sector, hit by energy costs and supply chain chaos, is shedding jobs in regions that were already economically fragile. Local councils, drowning in debt and facing government funding cuts, are slashing services and cutting staff. Each job loss creates another forced house sale. Each forced sale drives prices down further. Each price drop traps more homeowners in negative equity, making it impossible for them to move or remortgage. It's a downward spiral that feeds on itself, and we're only in the early stages. Then there's the rental market collapse that nobody's talking about. Landlords facing the same mortgage rate increases as homeowners, plus new taxes and regulations that eat into their profits, are selling up in massive numbers. Last year, 19% of landlords sold properties while only 8% bought new ones. That's a net loss of rental stock across the country, happening at exactly the moment when more families need rental accommodation because they can't afford to buy. The result is a rental market where demand massively exceeds supply, pushing rents to levels that would have seemed impossible just 5 years ago. In many British cities, average rent now exceeds the monthly payment on a mortgage for the same property. But getting a mortgage requires a deposit of £50,000 to £60,000 and income proof that most people can't provide. So families get trapped in expensive rentals, unable to save for a deposit because rent consumes 70% of their income. Meanwhile, the properties they're renting are being sold from under them as landlords exit the market. It's a cruel mathematical equation that has no solution for millions of British families. And this is all happening before we consider the external forces that are about to make everything worse. The international money that's been propping up British property prices is starting to pull back, and when it goes, the entire market will crash with it. For the past decade, overseas investors have treated British property like a safe deposit box. Chinese billionaires, Middle Eastern sovereign wealth funds, Russian oligarchs, and American investment firms have poured hundreds of billions into British real estate, not because they wanted to live here, but because it was a stable place to park money. They drove prices up across every major British city, pricing out local families but creating the illusion of a healthy market. Now that international money is flowing elsewhere, China's economic troubles mean fewer wealthy Chinese are moving money offshore. Middle Eastern investors are focused on their own massive development projects. American firms are finding better returns in their domestic market, and European investors are nervous about Britain's economic stability post-Brexit. The result is a massive reduction in the overseas demand that was artificially inflating British property prices. Without that international money, the true domestic demand for British property becomes clear, and it's nowhere near enough to support current prices. The average British worker simply cannot afford a £300,000 house, no matter how creative the mortgage products become. When prices were driven by international money, it didn't matter what British workers could afford. Now it's the only thing that matters, and the numbers don't work. Estate agents are starting to see this in real time. Properties that would have sold within days to overseas buyers are now sitting on the market for months. Developers who planned luxury towers for foreign investors are finding empty show flats and cancelled contracts. The market is discovering what British property is actually worth to people who earn British wages, and the answer is devastating for anyone who bought at international prices. But here's what makes this truly terrifying. Most homeowners, estate agents, and even property experts don't understand how connected everything is. They're looking for simple explanations about interest rates or supply and demand, missing the bigger picture of how multiple crises are combining to create something unprecedented in British economic history. Now let me tell you exactly which cities are going to be hit first and why, because the crash isn't going to happen evenly across the country. Some places are going to be devastated within months, while others might have a year or two before reality hits. Understanding this timeline could save your financial future or help you spot opportunities that others will miss. The first wave of destruction is already underway in what I call the mortgage shock cities. These are places where property prices rose fastest during the pandemic, creating the biggest gap between what people paid and what they can actually afford. Bristol sits at the top of this list, and Sarah's story from our introduction isn't unusual, it's typical. The average house price in Bristol hit £370,000 by late 2024, up from £280,000 just 3 years earlier. That £90,000 increase happened while average wages in Bristol rose by maybe £8,000. The math never worked, but low interest rates made it temporarily affordable. Now those interest rates are gone, and Bristol homeowners are discovering they bought into an unsustainable bubble. Estate agents in Bristol report properties sitting on the market for over 2 months, with asking prices being reduced weekly. Recent sales data shows actual transaction prices running 10 to 15% below asking prices from 6 months ago. The city's property market isn't just cooling, it's in freefall. Cardiff faces similar problems, but with an added twist that makes the situation even worse. Welsh house prices were already relatively affordable compared to England, but they've been inflated by English buyers fleeing high prices in Bath, Bristol, and London. Many Cardiff properties are now owned by people whose income comes from England, but whose mortgage payments are fixed to Welsh property values. As the English economy weakens and remote work becomes less common, these cross-border buyers are finding themselves financially overextended. They're starting to sell, flooding Cardiff's market with properties just as local demand weakens due to job losses in the Welsh public sector. Edinburgh represents a different type of crisis, what I call the independence uncertainty syndrome. Scottish independence polling has created massive uncertainty about Scotland's economic future, making both domestic and international buyers nervous about long-term investments north of the border. At the same time, Edinburgh's property prices have risen to levels that bear no relationship to Scottish wages. The average property price in Edinburgh now exceeds £400,000, while the average Scottish salary is around £31,000. That's a ratio that would be considered dangerous even in London, and it's completely unsustainable in Scotland's smaller economy. The result is a market where sellers are desperate to cash out before independence uncertainty deepens, while buyers are hesitant to commit to purchases that might lose value if Scotland's economy becomes isolated from the rest of the UK. This creates the perfect conditions for a price collapse that could happen very quickly once it begins. The second wave will hit what I call the industrial legacy cities, places like Liverpool, Birmingham and Manchester that experience property booms based on regeneration promises and economic transformation plans that are now falling apart. Birmingham is the poster child for this category, and what's happening there should terrify anyone who owns property in a post-industrial city. Birmingham's property market was built on a narrative of urban regeneration, HS2 connectivity, and its transformation into a modern economic powerhouse. International investors bought into this story, driving prices up across the city centre and surrounding areas. The average property price in Birmingham rose from £140,000 in 2018 to over £200,000 by 2024. But the reality behind the regeneration story is collapsing. HS2 costs have spiralled so far out of control that the Birmingham leg might be cancelled or severely reduced. The promised economic transformation has failed to materialise in ways that benefit ordinary Birmingham residents. Many of the new developments built for international investors sit half empty, creating an oversupply that will depress prices for years. Meanwhile, Birmingham Council has effectively declared bankruptcy, meaning the public services and infrastructure improvements that were supposed to support the property boom are being cut instead of expanded. The result is a city where property prices were artificially inflated by false promises, and the reality is now becoming impossible to ignore. International investors are pulling back, leaving a local market that can't support the prices they created. This pattern is being repeated across former industrial cities that base their property markets on regeneration promises rather than genuine economic fundamentals. Manchester faces similar challenges, but with the added problem of a student accommodation bubble that's about to burst. Universities expanded rapidly during the pandemic, building or commissioning thousands of student housing units based on projections of international student growth that haven't materialised. Brexit made it harder for European students to study in the UK, while visa restrictions and economic problems in China have reduced the number of Chinese students. The result is thousands of empty student housing units that were supposed to generate returns for property investors. As these investments fail, it creates broader uncertainty about Manchester's property market and forces investors to liquidate other holdings to cover their losses. Liverpool's situation is even worse because its property market was never based on solid fundamentals in the first place. Much of the city's recent property development was driven by overseas investors who were essentially money laundering through British real estate. As law enforcement and new regulations make this more difficult, the artificial demand that was supporting Liverpool's property prices is disappearing. Without that international money, Liverpool's property market is discovering that local wages simply cannot support the prices that were being paid by overseas investors. The third wave will devastate what I call the commuter belt trap cities, places that became expensive because people could live there and work in London or other major cities. But the work-from-home revolution has permanently changed commuting patterns, destroying the economic logic that made these places valuable. Reading, Oxford, Cambridge, Brighton, and dozens of smaller towns fall into this category, and they're facing a property crash that will be particularly brutal because it destroys their entire economic rationale for existing. Reading is the perfect example of this phenomenon. For decades, Reading's property market was driven by people who worked in London but wanted more space and a shorter commute than outer London could provide. Reading offered the perfect compromise. reasonable train connections to London, more affordable than central London, but still expensive enough to feel exclusive. The average house price in Reading hit £420,000 by 2024, entirely based on this commuter premium. But the work-from-home revolution has changed everything. If you only need to go to a London office 2 days per week, why pay Reading prices when you could live in much more affordable parts of the country? If you can work entirely remotely, why live near London at all? Young professionals are discovering they can buy a 4-bedroom house in Newcastle for the price of a 2-bedroom flat in Reading, and they're making that choice in increasing numbers. The result is a sudden loss of demand for Reading properties from the very demographic that created the town's property boom. Local estate agents report a collapse in inquiries from London workers, while local wages can't support the prices that London commuters were paying. Reading's property market faces a devastating adjustment as it discovers what local demand can actually support. Oxford and Cambridge face similar pressures, but with additional problems. Both cities have been incredibly expensive for decades, but international money helped push prices to levels that even highly educated professionals couldn't afford. The average house price in Oxford now exceeds £600,000, while the average salary for a university lecturer is around £50,000. Even doctors, lawyers, and senior academics struggle to afford housing in the cities where they work. This has created massive distortions in local economies and forced many professionals to commute from increasingly distant locations. But as remote work reduces the need for physical presence, many professionals are questioning why they're paying such high housing costs to work in Oxford or Cambridge. Universities, struggling with reduced international student income and government funding cuts, are also reducing their workforce, creating additional downward pressure on demand. Brighton represents the most extreme version of the commuter belt trap. Brighton's property market was built almost entirely on people who worked in London but wanted to live by the sea. The average house price in Brighton now exceeds £500,000, supported entirely by London money and London wages. But as London's own economy weakens and remote work reduces the need for expensive coastal living, Brighton's property market is losing its fundamental economic justification. Recent data shows a collapse in property viewings from London-based buyers, while local Brighton wages can't support even half of current property prices. But here's what's really terrifying about this unfolding crisis. The government's response is making everything worse instead of better. Every policy they've introduced to help homeowners and stabilize the property market is actually accelerating the crash and ensuring it will be more destructive when it fully hits. The stamp duty changes that were supposed to help first-time buyers have created artificial deadlines that are distorting the market in dangerous ways. Instead of creating sustainable affordability, they've created panic buying and selling that's destabilizing prices and creating false demand signals. The Help to Buy scheme, which was supposed to make homeownership more accessible, actually inflated prices by increasing the amount that buyers could bid for properties. Now that the scheme is being wound down, buyers who relied on government support are finding they can't afford current prices without it, removing a significant portion of demand from the market just as supply increases. Meanwhile, landlords are being hit with tax changes and new regulations that make buy-to-let investment much less attractive. The result is thousands of rental properties being sold just as more families need rental accommodation because they can't afford to buy. This is pushing up rents at the exact moment when home ownership is becoming less affordable, creating a perfect storm that traps families between unaffordable mortgages and unaffordable rents. The planning system, which successive governments have promised to reform, remains so complex and slow that it takes years to get permission for new housing development. This keeps supply artificially restricted even as demand falls, preventing the market from finding a natural balance between supply, demand, and price. Local councils, facing budget crises and political pressure, are making the situation worse by opposing new development while demanding that existing housing remains affordable. They're trying to solve an affordability crisis by restricting supply, which makes affordability worse for everyone. The result is a series of government interventions that work against each other and against market forces, creating the worst of all possible worlds. Artificial price inflation combined with restricted supply and uncertain demand. But the most dangerous government policy is the one they're not talking about: the deliberate inflation of asset prices through quantitative easing and low interest rates. For over a decade, the Bank of England has pumped hundreds of billions into the financial system, much of which found its way into property prices. This created artificial demand that pushed prices far above levels that could be sustained by ordinary income growth. Now that this artificial support is being removed through higher interest rates, property prices are adjusting back to levels that wages can actually support. But this adjustment means massive losses for anyone who bought during the artificial boom, and the government seems determined to prevent the natural correction that would restore affordability. The timeline for this collapse is accelerating faster than most experts predicted, and understanding the sequence of events could be the difference between financial survival and financial destruction. The crash isn't happening all at once or evenly across the country. It's rolling out in waves, each one building on the previous damage and creating conditions for the next phase of destruction. We're currently in what I call the recognition phase, where individual homeowners are starting to realize their personal situation is unsustainable, but the broader market hasn't acknowledged the scale of the problem. This is the phase where we see individual stories like Sarah's from Bristol, families quietly selling because they can't afford their new mortgage payments, but estate agents and property experts still talking about market adjustments and temporary corrections. Over the next 6 months, we'll move into the cascade phase, where individual problems become visible market trends. This is when estate agents start reporting longer selling times, reduced asking prices, and fewer buyers. Local newspapers begin running stories about families in financial difficulty, and property price data shows clear month-on-month declines rather than occasional blips. The recognition that this is a systemic problem rather than isolated cases will cause panic among homeowners who realize they need to sell before prices fall further. This creates a rush of new listings just as buyer demand is falling, accelerating the price decline and creating the conditions for the next phase. By early 2026, we'll be in the avalanche phase, where market psychology completely shifts from assumption of rising prices to certainty of falling prices. This is when the property market becomes genuinely dangerous for anyone involved in it. Buyers postpone purchases waiting for lower prices, while sellers become desperate to complete transactions before the market deteriorates further. Properties that were overpriced by 10% become overpriced by 20 or 30% as the market adjusts to new realities about affordability and demand. Media coverage shifts from individual stories to national crisis reporting, creating feedback loops that accelerate the psychological shift. Banks become more cautious about lending, making it harder for the remaining buyers to get mortgages, even as properties become more affordable. The avalanche phase typically lasts 12 to 18 months and sees the most dramatic price declines as all the factors that supported artificial prices disappear at once. By late 2026 or early 2027, we'll reach the floor phase, where prices stabilize at levels that genuine local demand can support. This phase can last several years and is characterized by very low transaction volumes, cautious buyers and sellers, and property prices that bear a reasonable relationship to local wages. The floor phase isn't necessarily the end of the crisis for individual homeowners, many of whom will be trapped in negative equity for years, but it represents the end of the dramatic price declines that characterize the earlier phases. Understanding which cities will hit each phase first is crucial for anyone trying to navigate this crisis. Bristol and Cardiff are already entering the cascade phase, with clear evidence of falling prices and rising inventory. Edinburgh and Birmingham will follow within the next 3 to 6 months as their specific problems intensify. Reading, Oxford and Brighton will likely enter the cascade phase by mid-2025 as the commuter premium completely disappears. Manchester and Liverpool have longer to go, but face potentially more severe crashes when their turns come. The cities that will be hit last and least severely are those with genuine economic fundamentals supporting their property markets, places with diversified economies, reasonable price-to-income ratios, and growing populations of young professionals. These tend to be smaller cities and towns that didn't experience the extreme price inflation of the past decade and have local economies that don't depend on London money or international investment. But even these relatively stable places will see property values decline as the national crisis affects consumer confidence and economic growth. The psychological impact of seeing major cities experience property crashes will affect buyer behavior everywhere, even in markets with strong fundamentals. And the broader economic recession that this property crash will help trigger will reduce demand for property everywhere as unemployment rises and household incomes fall. Here's what you need to know if you want to survive the coming crash or profit from the opportunities it will create. First, if you're a homeowner whose mortgage is due for renewal in the next 2 years, you need to act immediately. Contact mortgage brokers now to understand your options and lock in rates if possible. Don't wait until your current deal expires, because rates are only going in one direction and availability is getting tighter. If your new mortgage payment will be unaffordable, start planning your exit strategy now while you still have equity and before the market gets worse. Selling voluntarily while you can still make a profit is infinitely better than being forced to sell at a loss or losing your home to the bank. Second, if you're thinking about buying property, timing will be everything. Don't try to catch a falling knife by buying early in the crash thinking you're getting a bargain. Property prices in a real crash can fall much further and for much longer than most people expect. Wait for clear signs that prices have stabilized before making major purchases. However, start preparing now by improving your credit score, saving for larger deposits, and getting mortgage agreements in principle so you can act quickly when genuine opportunities appear. Third, if you're a renter being squeezed by rising rents and considering buying, be very careful about timing. The current rental crisis is real and painful, but buying at the peak of a property bubble to escape high rent could destroy your financial future. Consider alternative strategies like house sharing, moving to cheaper areas, or negotiating longer-term rental agreements at current rates if possible. Fourth, if you're an investor or have significant cash reserves, this crash will create opportunities not seen since the financial crisis. But successful crisis investing requires patience, cash reserves, and understanding of local markets. Focus on properties with genuine rental demand from essential workers, in areas with diverse economies and strong transport links. Avoid trying to time the bottom perfectly, but start accumulating quality properties once price declines have clearly begun in specific markets. The key to crisis investing is buying properties that will generate positive cash flow even if capital appreciation takes years to return. The broader economic impact of this property crash will reshape British society in ways that most people don't understand yet. Property has been the primary source of wealth creation for British families for the past 30 years, and when that source of wealth disappears, it changes everything about how the economy works and how families plan their financial futures. For older homeowners who bought decades ago, the crash represents a reduction in paper wealth, but not necessarily a personal crisis. Their mortgages are paid off, their housing costs are low, and they can ride out temporary price declines if necessary. But for younger homeowners who bought recently with large mortgages, the crash represents potential financial ruin that could affect them for decades. Negative equity, ruined credit scores, and forced sales will prevent an entire generation from participating in property ownership for years or even decades. This creates a generational wealth gap that will persist long after property prices recover, fundamentally altering British social structure. The rental market will also be transformed as millions of families who expected to become homeowners find themselves permanent renters instead. This increases demand for rental properties at exactly the time when landlords are selling, creating a structural shortage that will keep rents high even as property prices fall. The result is a society where housing costs consume an ever larger share of family incomes, whether through mortgages or rent, reducing spending on everything else and slowing economic growth across all sectors. Local governments will face budget crises as property values fall and council tax revenues decline, while demand for social services increases due to economic hardship. Many councils will be forced to cut services dramatically or raise council tax rates, adding to household financial pressure and accelerating the economic downward spiral. The construction industry, which employed millions and supported communities across the country, will contract dramatically as demand for new housing disappears. This will create unemployment in regions that were already economically fragile and reduce the supply of new housing that might help with long-term affordability. Banking and finance, central to the British economy, will face their own crisis as mortgage defaults rise and property-secured lending becomes much riskier. This could lead to credit rationing that makes the housing crisis worse by preventing qualified buyers from getting mortgages even for reasonably priced properties. But here's what the government and media won't tell you about what's really causing this crash. It's not a natural market correction or an unfortunate accident. This crisis is the predictable result of decades of policies that treated housing as a financial investment rather than a basic necessity. And the people who created this crisis are the same people who will profit from it. For 30 years, British governments of all parties have deliberately inflated property prices through planning restrictions, quantitative easing, and tax policies that favour property ownership over productive investment. They've encouraged ordinary families to borrow massive amounts to buy overpriced houses while allowing international money and institutional investors to drive prices beyond what domestic wages could support. The result is a property market that works for wealthy investors and property developers, but traps ordinary families in debt and unaffordable housing costs. When this artificial market inevitably collapses, the costs will be borne by ordinary homeowners and renters, while the benefits flow to cash-rich investors who can buy distressed properties at bargain prices. The same banks that created unaffordable mortgages will profit from foreclosures and forced selling. The same developers who built overpriced housing will buy land cheaply and profit from the next cycle. The same politicians who created the crisis will blame market forces while protecting the wealthy interests who fund their campaigns. This isn't a natural economic cycle. It's a wealth transfer mechanism that moves money from working families to financial elites through the housing market. Understanding this means recognizing that the crisis could be solved through policy changes that prioritize housing affordability over investment returns, but such changes would threaten powerful interests that profit from the current system. The crash will eventually end, but without fundamental changes to how housing policy works in Britain, the same cycle will repeat again in 10 or 15 years, with the next generation of families facing the same choices between unaffordable housing and financial ruin. The most important thing to understand about this crisis is that it's not just about property prices or even economics. It's about the kind of society we want to live in and who gets to participate in it. Housing is supposed to provide security, stability, and a foundation for building a life and family. When housing becomes a speculative investment that most people can't afford, it undermines the basic social contract that hard work and responsible behaviour will be rewarded with security and opportunity. The coming property crash represents both a crisis and an opportunity to reset British housing policy toward affordability and stability rather than speculation and profit. But that reset will only happen if enough people understand what's really going on and demand changes that prioritise homes over investments. The crash is coming, whether we prepare for it or not. The question is whether we'll learn from it and build a better system, or whether we'll just repeat the same mistakes with the next generation of families. The choices made over the next few years about how to respond to this crisis will determine whether Britain becomes a more equal society with affordable housing, or whether it becomes a more divided society where property ownership is a luxury that only the wealthy can afford. Your understanding of this crisis and your decisions about how to respond to it will shape not just your own financial future, but the kind of country your children will inherit.